Welcome to another edition of the Chicks on the Right podcast, where we have on our friend and sponsor of the show, Zach Abraham from Bulwark Capital Management, is with us once again. And just before we started recording this, you gave us a term that we have not heard before that we need an explanation of: doom spending. What is it?
Yeah.
It sounds fun.
Yeah.
It does.
Well, I read the headline and I was like, ooh, I'm in, right?
Yeah. Somebody tells me the world is ending and I'm like, I'm going doom spending.
Oh, yeah. Or
That's what I'm doing.
Yeah. Or
Yeah.
it's like the guy that builds the bunker out in the back of his yard, and packs it full of ammunition and guns. He's doom spending. That's what I was thinking. And, as a kid growing up watching movies like Commando, I was sitting there thinking, hey, I could get into some doom spending here.
Right.
Is it basically just prepping?
No,
'Cause that's what it sounds like. No?
So
It's what it sounds like.
So I think it's another nonsensical term that the media has made up to try to shield the Biden administration from any responsibility for the economic situation.
Surprise.
Right? We're just going to keep coining new terms and new phenomena, right? But I do think it says something interesting culturally. So what they're looking at is that they're talking about how, despite the fact that credit cards are maxed and you're seeing delinquencies soar, that people are basically grabbing every level or cash from any place that they possibly can. So you see loans against 401k balances shooting through the roof to extraordinarily high levels. And people are like, well, it's better than racking up debt. And you're sitting there going, do you know what it costs you to pull money out of a 401k? It's your personal income tax rate plus 10%.
I used to be in HR and handle benefits way back in the day.
Yeah.
And when anybody would come to me asking to take out a loan against their 401k, I judged them.
Yeah. Oh,
I secretly judged them.
Oh my God.
They're like
real.
trying to pay for their mother's surgery and stuff. And you're back there going, you financial Neanderthal.
I mean, I would never say anything, but secretly, I was like, this is not smart.
You shouldn't be doing this. This is not a good financial plan. Yeah.
You're managing your household like the Biden administration manages our country's finances. This is not good.
Yeah.
So, and then that's where the lesson would start, right? You'd start breaking them down a finance and civics lesson. But no, so I think it's one of these things where they're contextualizing it and trying to make it sound so. But it really is interesting because I think it's just a product of the greatest handout of money in the history of mankind. And that creates a sort of nihilism, right? Meaning you're spending money you don't have because somebody sent you a check. You're making more sitting at home than you were working. Buy it all, and you get into a mode, right? You get into a mode and you keep spending. And, this isn't new. People spending beyond their means in America. Oh my, that's crazy, right? So they're just talking about how basically the people are trying to treat their nerves or cope with hardships of the day to continue spending money they don't have. And I'm like, okay, well, you just described the peak of every economic cycle in history, right? That's what happens. So the crazy thing about it, though, and I don't really think people are seeing it the correct way. The crazy thing about it is when you look what's happening with delinquencies and you look what is happening with collections, the picture's changing a little bit right now where you're sitting there going, look, it's not so much you're going to see a reduction in consumer spending. We're seeing that, right? It was funny that they were touting around Costco numbers, which weren't bad, but Costco sales were up, 3.5% over the same month last year. Well, you've averaged 5% inflation over the last year. So that means adjusted for inflation, it's going down already, right? So I just don't think people are looking at all of these things in context. But anyway, getting back to the doom spending, one of the things, again, consumer spending is already going down. What I think people need to start thinking about is those people who are doom spending are doing it on consumer credit. A lot of that credit's going into delinquency and collections. Well, guess what's going to happen? Right?
Bailout?
Well, at some point, right? Yeah. No, but right, those people's credit get dinged and they're not able to access credit anymore. Right? So not only do they run out of money, but they're also not there for the bounce back in spending because they can't get any credit issuance. So, and they can after a while, but what I'm saying is not only are we exhausting current levels of consumer spending, but every time you see delinquency numbers going higher, that's one less consumer that's going to be able to access consumer credit. So, I mean, it's just, it's really funny to listen to the narrative. And we've been talking about this for the last month and a half. And I've been telling you guys every week, I don't know what the market's talking about. All we can do is look at the data. The data's headed the opposite way. Well, I just all of a sudden now in the last week, you're starting, the data is so consistent. It's not horrible yet. It's just all headed the wrong way. And it's,
I don't like how you said yet.
I know. I just thought the same thing. I'm like, he said yet.
Well, like I told you guys, you said it perfect, which was a bailout, right? I don't think because of that reason, I don't think that this is going to be really bad. Okay. What I do think is I think it's going to be shallower than a lot of the, perma bear out there people are saying, but you keep adding these things together. And what it's all screaming to us is it's not going to be that bad, but it's going to last longer than people think. Right. And remember, we've talked about these people losing access to consumer credit, which is part of delinquencies and all that other kind of stuff. But remember, the other thing is, unlike every other economic drawdown or every recession we've had in the past, one of the first shots of life into the economy's arms is the fact that interest rates go down in recessions. Well, when you think of the average mortgage in this country, the effective mortgage rate is 3.9. How far, in order to make that an attractive source of capital, you got to get rates far enough to where people can refi, which means the 30-year needs to be sub 3.9. Well, you're above 7 right now, right? So you start looking at it and you're like, not only are rate cuts going to be less stimulative than they ever have been before, but you're not going to be able to, I mean, people will refi some debt here and there, like it's not going to freeze, but you're just not going to get this. If you bought a house, if you mortgaged a house at 6.5% in 2007 or 2006, and you were able to refi it at 3.7 in 2011, that made a material difference to your household budget, right?
Yep.
Yeah, for sure.
Well, you're at 3.25 now. Where do rates got to go? And 3.25 were mortgage rates when rates were at 0. So even if you get back to 0, which I don't think the Fed's going to cut that far, but you don't have that relief there, right? This will be the first recession in the last 100 years where we do not have that wind at our back. So, and then you look at peak employment, which is good right now. But what is peak employment? Well, I mean, the last time unemployment was this low was 55 years ago. So,
wow.
People always forget about this, right? Stock market heights, valuations. It's great when you're up here. The problem, the thing you need to understand is you don't stay there, right? The view is always greatest from the top, so, and again, not saying it's collapse, but it just goes along to this doom spending, and all of these things just add up. And I think people have really been in denial this year based only by the movement in the equity markets and just not paying attention to underlying data. And you just see it really picking up steam. We saw it today in the jobless claim numbers that came out. The new jobless claims came in as expected, but nobody's paying attention to continued jobless claims now are higher than they were at any point over the last 5 years. Right. So,
wow.
Yay, 2024.
Right. And we're going to talk about, hey, it's still such a strong labor market. And you're like, well,
Right.
It's not a weak labor market, but it's not as strong as it was 6 months ago. Not even close. So, yeah, it's shaping up to be a great year, And
well, if people are doom spending, they're following the lead of our government, who constantly spends what they don't have. So you can't hardly blame them.
No, and here you brought up a really good point. Somebody asked me the other day in an interview. They were like, "Well, Zach, you're saying all these bad things. Why don't you think it's an absolute lock that we're going to have a really nasty recession? This sounds really bad." I think this will help your listeners, and it was kind of an eye opener to me even the other day when I came to this realization, but. In 2008, 2009, we all remember how bad the financial crisis was, right? We had, at that time, our economy was $16 trillion in size, okay? And the total economic contraction from the end of 2007 till the bottom in 2009, the economy contracted it was somewhere between 3.5 to 3.8%, okay? So you do the numbers on that, and it's right around on a $16 trillion economy. That equals about 600 billion, we'll call it. Okay. That means the economy contracted by 600 billion. We are running $2.1 trillion deficits right now. Okay. Our annual deficits are almost 4 times the size of the economic contraction in the great financial crisis.
Oh my God.
Right. So the one caveat that I give to perhaps there won't be a recession, and I still think it's a very, very low possibility that you're not going to go into recession, but it is tough to go into recession when you are spending that much money. I mean,
Yeah.
it's just crazy to me that people aren't freaking out about a $2.1 trillion deficit. It's just mind blowing.
It is mind blowing. It is. Okay, well, we learned a new word today, and we have you to thank for it. So thank you, Zach. Where can people learn more about you and about Bulwark Capital Management?
Yeah, well, if you guys can't tell, I think there's some scary times, but if you love this industry, they're very historic, interesting times, and we're watching this on a daily basis. So we put out a show every single day that's about 15 minutes long and summarizes all the market action and all important economic data that came out that day. That's called our Daily Dots. And then we do our 1 hour weekly show on Friday, usually with a 1 to 1.5 hour interview with another professional in the industry. And you can get all of that. There's no cost, just our podcast, Know Your Risk Radio podcast. You can just Google it, or we're on any podcast site. And yeah, easy to find. And we've had some really great guests, including a couple of the real players from The Big Short, the famous movie. And yeah, so trying to make it all clear to the folks and keep them up on what's going on.
Perfect.
Awesome.
Well, as always, you always teach us a lot, and we appreciate it. Thank you.
Oh, thanks for having us.
Zach.
It's fun as always.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. Information presented is for educational purposes only. It should not be considered specific investment advice, does not take into consideration your specific situation, and does not intend to make an offer or solicitation for the sale or purchase of any securities or investment strategies. Investments involve risk and are not guaranteed, and past performance is no guarantee of future results. For specific tax advice on strategy, consult with a qualified tax professional before implementing any strategy discussed herein.